Hi everyone! If you have vending machines business idea in mind, this video is for you. Today we will be doing the overview of the financial model. Also, we will be covering the inputs that affect financial efficiency: revenues, costs, profit, payback period, financing needed, and many others.
The link to download this model will be placed in the description of this video. Also, you will be able to find other financial models overviews in the description of this video. We can also automate your reporting environment using Excel or Power BI tools. You can also check out other financial models and Power BI tutorials for business owners.
All the links you will be able to find in the description of this video. If you find this content valuable, please hit the subscribe button and give us a like. Share this video with your friends who have their own businesses. All inputs in our financial model are colored with blue. This will help you easily find and play with all inputs across the model. First of all, we need to set up the first year of financial projections. That will be the year when investment stage begins.
Then we have a very simple table with global coefficients for the revenues and cost parameters. Using these coefficients, we can quickly build different scenarios and see the cash flow statement, simple and discounted payback period diagrams, and other financials for the scenario that we've just created. If we want to increase the revenues by 20%, simply type here 120. If you want to decrease the amount of customers by 30%, simply type 70% here, and you are done.
Moving to the next block of inputs. Here we will be describing the types of vending machines that we potentially will be installing. Snack vending machines, beverage vending machines, and many others. We have 20 types of vending machines that we can specify. First column, we are naming vending machine types, one by one.
Next column. Here we can switch on and switch off each type of vending machine from our project and see financial efficiency with or without this or that type of vending machine. Then we set up an average check for each type of vending machines. We also have scenario modeling coefficient added to the average check. This coefficient increases or decreases all the pricing, while this column of coefficients allows us play with the average check individually for each type of vending machine.
Then we specify the percentage of direct costs sitting inside the average checks: snacks, beverage costs, and so on. We also have scenario modeling coefficients for the level of direct costs. Then we specify how much we invest in each type of vending machine. Scenario modeling coefficients for the investments live here.
We may also have some maintenance expenses that occur monthly for each type of vending machines, adding scenario modeling coefficients to maintenance costs. Then, we may have some periodic maintenance costs that occur once in a specific period of time, once in 5 months or once in 12 months, and so on.
We have 5 types of those costs. Here, we can set up the amount for these costs per payment, and here, we can specify the payments intervals in months. Here, we can see the dollar amount for these costs, and here are the intervals for these expenses in months. Then we have asset tax monthly payments with scenario modeling coefficients added.
Moving to the next block of inputs. Here, we need to specify the amount of average checks for each type of vending machines for each day inside the typical week. This is a very important block of inputs because here we can set up the seasonality for the amount of customers inside typical week. Some vending machines may be installed in business centers, so they will have almost zero in revenues during the weekend. On the contrary, some vending machines may have less in revenues from Monday to Friday, but have a surge on weekends.
Or the revenues may be stable because the vending machine is working at the airport. We may also have some seasonality in sales inside the typical year. On the top, we have our typical year from January to December. From top to the bottom, we have our types of vending machines. In this area, we specify decrease or increase for the revenues in percentage format.
100% equals to this amount of customers. Then we have a scenario modeling coefficients for the amount of customers. So you can see that the model is very flexible. When we launch each vending machine, we won't be able to reach target revenues right from the first month of operating activity. Here, we can specify how fast we reach the target revenues in percentage format.
Now we are moving to the core of our financial model. First column, we are choosing the type of vending machine that we are going to launch. Next column, we can switch it on and off from our calculations. And here, we are specifying when the specific vending machine starts its operating activity, starts giving the revenues, year and month.
So here in this core, we can set up to 200 of vending machines. Each of these 200 vending machines may represent one of 20 vending machines types. So the model is very flexible. Payroll. We may have some payroll that is directly connected to the amount of vending machines that we currently operate. Here we specify the position. Then goes salary per person on each position. And then we can specify how many vending machines can be under one person on this position. So when we will be adding vending machine inside the core, this direct payroll will be calculated automatically. We may also have some direct cost per each vending machine that we currently operate. Here we can specify these expenses per one vending machine per month.
We may also have a management company that will be operating all our vending machines. In the next block of inputs, we can specify what we are investing in. What is the price per one unit of item that we are going to invest in? Then we set up how many units we are investing in. Pay attention! Here we are not describing the investment in vending machines. Here we are talking only about everything but vending machines.
Then we have fixed costs for the management company. The names for the fixed cost items are here. Here are monthly values for these expenses. Moving to the payroll for the management company, starting with position names. Then salary per person per month on each position. We also have some inputs for the loan. Amount of loan, when we get this loan, year and month, term of loan in months, interest rate, grace period for principal and interest payments in months.
Then we have taxes, revenues, profit, payroll, asset. Here we can see the cash flow. We can press plus button to see all the details. For revenues, direct costs, fixed costs, payroll and taxes, and investment plan. The result from operating activity will show us how much we earn without loan payment and investment plan expenses.
The result from investment activity will show us what we need to invest in, how much, and when. Then we have the result from financing activity. During first stage of the project, it shows us equity and loan inflow inside our business idea. On the second stage, it shows us loan payments and how they correspond with the result from operating activity. The last line of the cash flow statement, which is cash balance at the end of the period, shows us on the first stage how your project consumes equity and loan. On the second stage, it shows us how much cash will be generated by your business idea by this or that moment in the future.
Then we need to specify a discount rate for our project. It lives here. We also have increment for internal rate of return calculation. Next table is very important. It shows financials for the current scenario, simple and discounted payback periods, profitability index, net income, net present value, equity, loan, and total financing needed. And finally, internal rate of return.
Next output. Here we placed a very simple table showing us total revenues, total costs, and profit done monthly, plus loan coverage ratio. Here we have a tab with simple and discounted payback periods diagrams. The moment when each diagram crosses the time axis is the moment of the payback. Then we have sensitivity analysis. We are adding this parameter to the revenues or cost inputs to see financial efficiency if the value of this parameter will increase or decrease with this increment. We can press Sense button and see how financial model reacts if revenues or other costs will increase or decrease on this or that percentage value.
The link to download this model will be placed in the description of this video. We can also automate your reporting environment using Excel or Power BI tools. You can also check out other financial models and Power BI tutorials for a business owner. If you find our content valuable, please hit the subscribe button and give us a like. Share this video with your friends who have their own businesses. Stay tuned! See you in next videos!